All right, so here's our trade recap for Wednesday, January 14th. I posted this trade onto YouTube. I was live on Discord, and let's do a quick trade recap to see exactly why I took this trade and what I was thinking. So we're on the 1 minute here. So we're going to move over to the 15 minute and have a look at this trade here. Okay, so here's the logic behind it. Here's our trade here on Wednesday where we wanted to get in. And you can see we clearly did not take this low down here. However, we did take this low right here, but this is just what's called basically the distribution down, right? And you see it's 154 points here with your ruler. So it's too deep into the liquidity pool. You needed to take this low right here. So it did not take it. So going back to the 1 minute, let me show you something. And you can see what happened here is this leg right here that you're looking at. You can see we've come up and we've closed over these swing lows right here. See up here? So technically this is minor buy side liquidity. There were some buyers in here and it came down and it stopped them out right here. Okay. So when I saw that, my rules that apply to me are, is it in a high time frame fair value gap? And as you can see over here on the 4 hour, this is where you want to get into the trade right here. And you can see that we've come into this 4 hour fair value gap imbalance candle right here. Also, you can see in behind it, it says daily. It just came into a 4 hour, a 1 hour, and a 1 hour as well. Okay, back to the 1 minute. So on the 1 minute here, because we broke this low right here, and this leg in particular, right in here that we're looking at, broke these highs right here, meaning that we can call this a substantial minor buy side liquidity. Okay, sell side actually right here. So we broke it. So that's called the redistribution sweep that I always talk about. And there needs to be a high time frame fair value gap. As you can see, we found a 4 hour, a 1 hour, and a daily in here, correct? And we entered this trade after this sweep right here on this breaker block here. So we had the price go up here and we displaced the breaker here. And you can see that we just displaced over it. But it left a fair value gap on the following one. And I didn't want to take it up here because we'd get a better stop on the breakaway gap. So we took it on this breakaway gap right in here. So we got in right here, market came up, came back down and hit our entry right here, and price just continued. You can, if you remember in the video, I had my stop loss actually on the middle of this downed order block right here, as opposed to the low, because the stop was getting too big. I didn't want it any more than 50 points. So my stop was somewhere like here, and it came out right here and it redistributed one more time and it stopped us out right here. All right, c'est la vie. Okay, not a big deal. We can now enter, because it swept these lows right here, we can now enter another position. Now, this is your last shot, so you got to make sure, and you have to have a bias, which we're going to do today. We're going to go over how you calculate this bias. I don't just randomly on sweeps like this try to get in, okay? So the reason why here we got back in is because we had a resweep right here, and then we had this breaker block right here. You see how this is a breaker right in here? This is the short-term high here on this wick. This is the short-term high here that created this short-term low right here. That's the breaker block right here. We displaced over it. We then entered a position, a long position on the breakaway candle, this being the breakaway candle. And you can see there's a gap here, and I can't remember exactly where we took it. I think I took it right here. And I know my stop loss came to the low here, 1 point below the low, 50 points. And because we were down one, it was kind of my mistake, and we were counter trend, I set this right at 100 points right here. I definitely should have put it right here and stretched it to a 1.3.34. This is the first high right here that gives you a 1 to 2 or beyond. This one right here doesn't. But because we lost one, we justified it 100 points. We increased the leverage slightly. I think there was 13 contracts. And now we have a good winning day and a 1 to 2 exactly. So moving forward here, let's show you how I calculate this bias for these sweeps right here that you see, because you have to be very careful. One thing I'm going to mention one more time. You need to be very careful on what you're calling a minor sweep of liquidity. And if you call every single one, well, you're going to be wrong 1,000 times, because this market could be trending down we're actually in a downtrend here, right? So you have to make sure that the sweep, the leg itself, so this one was very solid. I let it break swing highs. This one here that we got into where we lost, like I said a while ago, it did not break a swing high like up here, but this one did, and it was obvious that it was engineering liquidity. That's all this is an engineer of liquidity. But we need a solid bias to help our probability in deciding when we're going to get in on these sweeps. And here's exactly how it's done. So you want to start off always on the daily. This is Wednesday's trade right here. Here's the low of the wick right in here. And you can see that we've come into this daily fair value gap right in here. Would be bullish. You'd have one for the day. Moving down to the 4-hour. This is Wednesday's trade right in here. You can see we've tapped into this 4-hour bullish gap right in here. The 4-hour bullish as well. Moving down to the 1-hour now. So you can see on the 1-hour here that we've stretched the screen out on the 1-hour here. And you can see down here that this wick before we got in, but actually that was the first trade. This trade right here, we were in this bullish gap. So this 1-hour gap right here wasn't inverted the first time we took the trade. But in the second time, when it redistributed, we actually inverted this 1-hour bullish gap, making the 1-hour here is now bearish. Now moving down to the 15-minute, we skipped the half an hour, of course. Moving down to the 15-minute, this is where you have to be very careful. You have to kind of go all the way over to the left. And you can see on the 15-minute, we had this bullish gap right in here. So the 15-minute is now bullish. So let's look at our telly. You use the daily, the 4-hour, the 1-hour, and the 15-minute, and the 5-minute. Once you have 3 out of 5, then you have your bias for the day. And that's how we calculate the bias for the unicorn model. For my continuation model, I use the 15-minute to 30-minute trends to dictate it, and I don't use the method of the fair value gap high time frame. If it's minor sell side, make sure it really is minor. Like this one, this leg right here, for example, that my mouse is going down, it definitely swept it. That is definitely minor sell side liquidity right in here. This one was absolutely weak. This one was weak, but this one over here was absolutely minor sell side liquidity. And what does it have to line up in? It has to line up in this high time frame fair value gap with this bias method that I just showed you. And you have to do it in one of these 3 macros, the first AM macro, second AM macro, and the third AM macro. We push it to the 4th continuation model only when there's a red folder. And if you listen to these rules and you look for proper displacement, proper fair value gaps, you're going to kill it at this, especially with YM. All right, I hope all that makes sense. See you guys live on the Discord tomorrow.